Hello, everyone. We have recently published our GCC Equities Strategy Note 2023, titled Certain Stocks for the Uncertain Times, which includes our top ideas for FY 2023. With me here is Nishit Lakotia, our head of research, to discuss the key themes we address in our strategy note.
Thanks, Amaya. This year, we are not as positive as we were last year. If you have to look at our strategy note title, last year was an oasis within the global storm. But at hindsight, though we were right last year, this year looks more challenging. Well, on the primary market space, the performance was more stellar in the markets with 28 IPOs and listing during the year, with 70% of these listings beating their respective benchmarks and giving positive total returns. However, now if we look ahead, given where the interest rates are, Fed tightening, overall activity in the markets have already been subdued, especially on the turnover side. But if you look at even the discount rates, has been very high. Equities as an asset class will look more challenging or less attractive. So it's important that there should be a bottom-up approach this year more than the top-down, and active management will do better than passive approach.
So let's begin with oil. Where do you see it in 2023?
Uncertainty is the only certainty here. For now, it is hard to see a significant bear case in oil with the return of China, some recovery in Europe, even Russia planning to cut some output from next month. So we think that oil has a good base at current levels around $85. That's where we will also assume oil to be. But if you look at yeah, $85 versus $100, which was the case last year, then the fiscal surplus this year would be lower. Not so much of a concern because most of the economies will still be comfortable at these levels. But more importantly than the oil levels, the question will remain on the speed of the government-led capex stimulus, and also how much of the funds from sovereign and quasi-sovereign entities flow into the strategic projects.
Next, I'd like to discuss IPOs. Do you expect the momentum to continue in 2023?
The pipeline looks strong, especially in the first quarter. We've seen that even Qatar and Oman IPOs are happening as we speak. But however, I think this year there will be more focus on the valuations. The valuations has to be reasonable, otherwise the markets will penalize anything that does not fly around in terms of valuations.
This brings me to the banking sector. How do you see it doing in the GCC?
Compared to the emerging market peers, generally GCC banks are better placed in a rising interest rate environment. Coupled with reasonably high crude prices, it's a good story, and this is what was the story that played even last year, especially in the first half. However, given that the surge in interest rates have been pretty high, unprecedented rather, in the last 12 months, after the initial NIM expansion, it appears to be more or less stabilizing. And we expect NIMs to be flat for 2023, with possibly exception of Saudi banks, which may in fact see some mild contraction, unless obviously they strategize to cut the pace of the lending book growth. So high borrowing prices will ensure low, borrowing demand as well. High crude prices by public sector entities, and these things could also impact the asset quality with delinquencies going up. Overall, we prefer Dubai-based banks in the first half. We think they will benefit from elevated NIMs, while the second half of this year could be the play with Qatari banks as government spending should ideally pick up. And we are broadly skeptical on Saudi banks until we see normalization of the liquidity within the sector, and banks with CASA book, better CASA book should do fine.
Now that you mentioned Saudi, I'd like to discuss, is there any opportunities in the commodity space? And then that follows with the discussion on cement sector.
Well, in commodities, asset valuation, if you look at the petchems, they are approaching multi-year lows in the Saudi petchem space. Although arguably there is still more downside from just the prism of valuation metrics. However, from longer term perspective, if you just ignore 2023, these are the levels where one may want to get into for within the sector. And outside of Peckham, we remain quite bullish on the aluminum sector, aluminum space. Not exuberant, but yes, we are bullish on that. And talking about cement, well, the higher rates and slowdown mortgage activity is something to be concerned about. But we think that first half last year the pricing was very depressed, so accordingly we'll see some earning optics better in the first half of this year. And then Riyadh potentially, bagging Expo 2020. There will be a strong narrative overall in the Saudi space construction side, and that should help the overall sector. And we generally prefer more central region over other parts in Saudi Arabia.
Let's move on to the UAE real estate, Dubai versus Abu Dhabi. Which is better in your view?
Well, within UAE real estate, we prefer Dubai. Simply because Chinese buyers are now returning. They obviously last year was also fantastic for Dubai, and not just Chinese buyer, but the macro growing population and government initiative that they've taken. Overall, tourist arrivals are still 15% below COVID levels. So the traction should in Dubai should continue. Price increases may not be at the level at which we've seen, but given a choice between them, Dubai is the place to be.
And quickly on airlines, do they still have an upside after rallying in FY22?
Yes, the airlines had a fantastic FY22 and it was well deserved. Both the airlines in the listed space had very strong balance sheet and did very well, offers decent yield. So the theme played out well. Now the base effect will matter this year. So it's a tricky call. I think you'll have to be, a bit tepid in your expectations on the sector.
And if we can just briefly cover our view on telecoms and then followed by the consumers and healthcare.
Okay, in telecom, we were generally negative last year, so we are not as negative this year because most of the stocks fell and the valuation looks more reasonable. But even then, if you have to pick any particular country, then Saudi telecoms in general looks more better given the strong macros, core business doing well, and tourism, government spending. So one way to play this sector would be to focus on Saudi. And within consumers, I think staples will do better again this year than discretionary. Many of these companies have passed on the inflation cost to some extent by raising prices. That's going to protect their margins. So they should be overall fine. Even QSR space looks interesting given the recent IPOs. It could be one way to play this sector for the year. And for healthcare, we generally are bullish on the Saudi healthcare space. The sector offers strong cash flow generation by many of these companies. Leverage is low, it remains underpenetrated, and the expansion of the pipeline of the hospitals for many of these companies are strong in the coming years. So it's a overall a good story. So with this, I just want to conclude that our strategy note discusses some top 15 interesting ideas on that the clients should play with expectations being more moderate this year than what it was last year.
Thank you, Nishit. And with that, I'd like to remind you that you can visit our research portal, research.sicobank.com, to access our strategy note. Thank you.